All right, today we're diving into the story of a real disruptor, a company that didn't just play the game, it completely changed the rules for Indian investors. We're talking, of course, about Zerodha.
And it really all boils down to this. How in the world did one company manage to save Indian investors a mind-boggling 20,000 crore rupees? And, here's the kicker, is that whole era about to come to a screeching halt?
Okay, so to really get what Zerodha did, we've got to rewind the clock a bit. Let's talk about the biggest, most frustrating hurdle for traders back in the day. And it all came down to a little thing called a percentage.
So picture this. It's before 2010. You want to get into the stock market. What's the biggest thing holding you back? It wasn't just about the stress of picking the right company. No, there was this other barrier, something kind of hidden right there in plain sight.
And you know who nailed it? Zerodha's own founder, Nithin Kamath. He had this great term for it, percentage blindness. Think about it, a brokerage fee of, say, 0.5%. It sounds like nothing, right? So small you just ignore it. But oh man, those tiny little percentages were actually a huge drain on your real returns.
So yeah, that was the old model in a nutshell. The big, traditional brokers would charge you a percentage on every single trade. The more money you put in, the more they took. It was like this hidden tax, this death by 1,000 cuts that just kept adding up and slowly but surely bleeding your profits dry.
But where most people saw a broken system, one trader saw a massive opportunity. He looked at all this and thought, you know what? I can build something better. Something built by a trader for traders.
And look, Nithin Kamath wasn't some suit who just saw a business plan. This guy lived and breathed the market. He started trading when he was just a teenager, lost a bunch of money in the early 2000s, learning the hard way, and even worked nights at a call center just to keep his trading going. But the key thing? He became a sub-broker. That gave him this incredible front-row seat to see just how flawed and expensive the whole industry was. For him, this wasn't just about making money. It was personal.
So in 2010, he launched Zerodha. And the name? It's actually pretty brilliant. It's a mashup of zero and rotha, which is the Sanskrit word for barriers. The whole mission statement was baked right into the company name, Zero Barriers. And what happened next was just, well, it was staggering. I mean, they went from just 5 people and a few clients to over 11 million clients and more than 1,000 employees. But here's the really wild part. They did it all with zero funding, not a single rupee from outside investors. This whole thing was bootstrapped, built from the ground up by just solving a real problem for people.
But here's the thing. Just being cheap wasn't the endgame. Nope. The real revolution, the move that would absolutely change everything, that was still on the way.
Fast forward to December 2015. Zerodha makes a move that was so radical, so unthinkable at the time, that pretty much everyone else in the industry thought they were completely insane.
And this was it. They announced that brokerage for all equity delivery trades, when you buy a stock to actually hold on to it, would be zero, zilch, nada. It was an absolute game changer.
And the impact of that one word, zero, it was just monumental. We're talking an estimated savings for investors of 20,000 crore rupees over the next decade, all because they got rid of one tiny, annoying barrier.
But here comes the twist in our story. All this explosive growth, all these new people jumping into the market thanks to companies like Zerodha, well, it caught the eye of the regulators. And now, the system is starting to push back with what people are calling speed breakers.
You see, this huge wave of new traders, especially in the fast and furious world of futures and options, it made policymakers a little nervous. They started getting concerned about all the speculative trading and decided, okay, maybe it's time to add a little bit of friction back into the system.
So there are 2 big changes coming down the pike, both kicking in on October 1st, 2024. First up, a pretty big hike in something called the Securities Transaction Tax, or STT. And second, a new rule called True to Label, which totally flips the script on how brokers deal with exchange fees.
And if you're wondering why they're focused on the STT, just follow the money. The government's tax revenue from these trades has absolutely exploded, and F&O trading alone accounts for almost half of it. When a number gets that big, you can bet it's going to get some attention.
So let's dig into that first speed breaker. The STT on options trading is jumping from 0.0625% to 0.1%. Now, I know those numbers look tiny, but do the math. That's a 60% hike, a 60% jump in the tax you pay on every single options trade. For anyone who trades frequently, that adds up fast.
All right, now for that second speed breaker, the True the Label rule.
This one's a little more in the weeds, but it hits right at the core of how discount brokers make money. See, for a long time, big brokers would get these huge volume discounts from the stock exchanges. So they could charge you, the customer, a standard fee, but then turn around and pay the exchange way less and pocket the difference. Well, this new rule says no more. It's all about transparency now. What you get charged has to be exactly what the broker pays.
And the financial hit from this one rule is not small. For discount brokers, that little profit margin was a huge part of their business model. Now, forecasts say their profits could get slashed by anywhere from 15 to 25%. That's a massive blow. Meanwhile, the old-school full-stack brokers, they've got other ways to make money, so for them, it's barely a blip on the radar.
Okay, so we've got the revolution and now we've got the reaction, which leads us to the big finale, the most important question of all. What does any of this actually mean for you?
Well, the bottom line is things are definitely changing. If you're an active trader, especially in F&O, your costs are going up, full stop. To make up for their lost profits, discount brokers might have no choice but to raise their fees, maybe by 10, even 20%. And just like that, the era of zero-cost trading could be over. The regulators might be aiming for a level playing field, but for the average investor, it might just mean a more expensive one.
And that leaves us right here with one final massive question. We had a disruptor that democratized investing for millions of people. But now, are these new rules, designed to create stability, going to accidentally make investing expensive all over again? Are we about to see the walls that were torn down get built right back up? That right there is the question that will define the next chapter for Indian investors.